I'm Jelian Calagos and I'm going to make a video report about the topic of Group 4, which is a financial manager. So, who is a financial manager? A financial manager is someone who oversees the financial health of an organization and helps ensure financial sustainability. They supervise many important functions such as monitoring cash flow, managing expenses, producing accurate financial data, and strategizing for a profit. A financial manager is a professional responsible for overseeing the financial activities of an organization. So their main role is to ensure the financial health and stability of the company by developing and implementing strategies to maximize profitability and minimize financial risks. So, the role of a financial manager encompasses a wide range of responsibilities aimed at maintaining and improving an organization's financial. Some key roles and responsibilities include first is financial planning, developing strategic financial plans and forecasts to achieve the organization's long-term goals. So this involves budgeting, setting financial targets, and allocating resources efficiently. Developing financial plans and strategies to support the organization's goals and objectives. So the second is financial reporting, is generating accurate and timely financial reports, including income statements, balance sheets, cash flow statements, and other financial documents. So these reports help stakeholders understand the company's financial performance, creating accurate and timely financial reports, and ensuring compliance with accounting standards. So, number three is the risk management. Identifying, assessing, and managing various financial risks such as market risk, credit risk, liquidity risk, and operational risk. Implementing strategies to mitigate these risks is crucial for financial stability. Identifying, assessing, and managing financial risks that could impact the organization's stability. So the capital management is making decisions regarding capital structure, raising funds, and managing the company's capital to optimize financial resources while balancing debt and equity. So the managing the organization's capital structure and evaluating funding options. So, number five is the investment management, evaluating investment opportunities, and managing portfolios and making decisions on how to allocate funds to maximize returns while considering risk tolerance. So, analyzing investment opportunities and maintaining the organization's investment portfolio. So, number six is the financial compliance, ensuring compliance with financial regulations, accounting standards, and tax laws. So, financial managers need to stay updated on regulatory changes that may impact the organization. So, ensuring compliance with financial regulations and reporting requirements. So, number seven is strategic decision making, advising senior management on financial implications and providing insights for strategic decisions, mergers, acquisitions, or expansions. Providing financial expertise to support strategic decision making processes. So, number eight is financial analysis. Conducting through financial analysis to assess performance, profitability, and efficiency, providing recommendations for improvement. Analyzing financial data to provide insights and recommendations for business improvement. So, nine is the stakeholder communication. Collaborating and communicating effectively with various stakeholders, including investors, executives, and regulatory bodies, to convey financial information and strategies. So, communicating financial information to stakeholders and collaborating with other departments to achieve financial goals. These rules and responsibilities collective aim to maintain and improve the financial health of an organization by effectively managing finances, mitigating risks, making informed decisions, and ensuring the compliance with the financial regulations. So let's go to the deep capital. Deep capital is a fund that a company or organization raises by borrowing from lenders. Investment must be paid with interest. That capital is a valuable source of funding for businesses and can be for various purposes, including expansion, acquisition, and working capital. So this type of capital must be repaid with interest. Deep capital is commonly used by a business for various purposes, such as expansion, acquisition, and working capital. So bank loans is a borrowing bank loans from financial institutions or bank is generally used for working capital or asset acquisition. So the simplest type of business loan is a bank loan. This works just like a personal bank loan. Your business borrows a sum of money and pays it back over a set period of time, with interest charges added. One way to raise that the capital is through bank loans. So this involves borrowing money from financial institutions or banks, typically for working capital or asset acquisition. So the loan is repaid over a set period of time with added interest charges. So the bonds is these are the securities sold to investors that pay either a fixed or variable interest rate. So in a simple terms, a bond is a loan from an investor to borrower such as a company or government. The borrower uses the money to fund its operations and the investor receives interest of the investment. So bonds are another form of debt capital. These are debt securities sold to investors who received fixed or variable interest payments. Bonds are essentially loans from investors to borrowers such as companies or governments. The borrowed money is used to fund operations, and investors receive the interest on their investment. So lines of credit, these facilities allow a business to borrow money up to a predetermined limit as needed. A line of credit is a flexible loan from a financial institution that consists of a defined amount of money that you can access as needed. You can repay what you borrow from a line of credit immediately or over time in a regular minimum payments. Interest is charged in the line of credit as soon as money is borrowed. These are flexible facilities that allow businesses to borrow money up to predetermined limit as needed. So this form of debt capital provides businesses with the flexibility to access funds when required. Interest is charged on the borrowed amount from the moment it is withdrawn. So equipment financing, this type of debt financing wherein a company borrows money to purchase equipment, which serves as collateral for the loan. Equipment finance describes a loan or lease that is used to obtain business equipment. It can be any tangible assets such as office, furniture, machine tools, vehicles, and computers, and also hospital MRI. So this type of equipment financing can be done by obtaining a loan to purchase equipment or by leasing equipment. So is a type of debt financing where a company borrows money to purchase equipment, which serves as collateral for the loan. So this allows businesses to acquire necessary equipment without upfront payment. So paying back the borrowed amount over time. So, commercial paper as this is a short-term unsecured promissory note corporations issue to raise funds quickly. So, commercial paper is a short-term unsecured promissory note that corporations issue to raise funds quickly. So, this type of debt capital allows companies to access immediate funding for their short needs. So this passage discusses different type of securities used in finance. So government bonds are issued by governments to support spending and obligations and are considered low-risk investments. So equity capital is money raised by a company from owners and shareholders in the exchange for ownership in the company and is not required to be repaid. So common stock and preferred stock are types of equity that represent ownership in a company. So private equity and venture capital are forms of investment in private companies. So crowdfunding is a way of raising money for projects and businesses by collecting small amounts from a large number of people. So stock warrants give the holder the right to buy or sell a specific number of shares of a company's stock at a predetermined price within a certain time frame. So let's go to the short-term financing. It means business financing from short-term sources which are for less than 1 year. So it refers to the acquisitions of funds for companies' operations that are expected to be repaid within a relatively brief period. Typically within a year, this type of financing is used to meet the short-term needs of a business such as covering operational expenses, managing inventory, or handling temporary cash flow gaps. So, the choice of short term financing depends on factors such as the urgency of funding needs, cost of financing, credit worthiness, and the specific requirements of the business. So it is important for businesses to carefully evaluate and select the most suitable short-term financing option to meet their immediate funding needs while considering the impact and overall financial health and cost of a borrowing. So here are the sources of short-term financing. So trade credit is this involves delaying payments to suppliers for goods and services. Receipt it is a common source of a short-term financing as it provides a grace period to settle bills. So delaying payments to suppliers for goods and services received, providing a grace period to settle bills. So bank loans is businesses can obtain short-term loans from banks to cover their immediate financial needs. These loans may be in the form of lines of credit, working capital loans, or overdraft facilities. So obtaining short-term loans from banks to cover immediate financial needs. These loans may be in the form of lines of credit, working capital loans, or overdraft facilities. So, personal saving is entrepreneurs often use their personal savings to finance short-term needs in the early stages of a business. Entrepreneurs often use their personal savings to finance short-term needs in the early stages of a business. So factoring is companies can sell their account receivable to a factoring company at a discount, which provides immediate cash that transfer the responsibility of collecting payment to the factoring company. So selling account receivable to a factoring company at a discount, which provides immediate cash but transfer the responsibility of collecting payment to the factor company. So short-term business credit card, companies can use business credit cards to cover immediate expenses. So these cards often come with a grace period during which no interest is charged if the balance is paid in full. So short-term business credit card is a financial tool specifically designed for businesses to cover short-term expenses and manage cash flow. It functions similarly to a personal credit card, but with features and benefits tailored to business needs. So, the main topic definition of long-term financing. Equity financing is the process of raising capital through the sale of shares. Share companies raise money because they might have a short-term need to pay bill or need funds for a long-term project that promotes growth. So, raising capital by selling shares of the company to investors. So, this provides ownership in the company and can be used to finance long-term projects or support growth. Debt financing is essentially the act of uh, raising or a bank to be repaid at a future date in return for a loan. Creditors are the own the interest in the money. Borrowed lenders typically require monthly payments on the both short-term and long-term schedules. So, borrowing money from lenders such as banks or financial institutions with the agreement to repay the borrowed amount plus interest over a specified period. Debt financing can be used for both short-term and long-term needs. So retained earnings are the amount of profit a company has left over after paying all its direct costs, indirect cost, income, taxes, and dividends to shareholders. So the portion of a company's profits that it reinvested into the business and instead of being distributed as dividends to shareholders. Retained earnings can be used as a source of long-term financing for capital expenditures or expansion. So venture capital is a form of private equity and a type of financing that investors provide to startup companies and also small businesses that are believed to have long-term growth potential. So funding provided by investors to startup companies or small businesses that have high growth potential. So venture capitalists typically invest in exchange for equity and provide expertise and support to help the company grow. So, these various sources of long-term financing provide businesses with the necessary capital to fund projects, expand operations, and achieve long-term goals. The choice of financing method depends on the factors such as the company's financial position, growth prospects, risk appetite, and the specific requirements of the project or investment. So it is important for businesses to carefully evaluate their financing options and select the most suitable method to support their long-term financial objectives. Thank you.